Thank you, Barbara. Thank you, everyone, for being here. I want to extend my gratitude to Catholic University for hosting us and to Federico for inviting me in particular and bringing me down here also. Just so you guys know, I don't speak Spanish. I flew in here. I was very discombobulated, and so I didn't have time to get any pesos, so I have no money. Basically, I'm relying on them to pick me up, to take me to get food at night. And so I'm completely reliant upon them. Nicholas is basically my babysitter. Maria Blanco, Professor Blanco, who just gave you that talk, she was very nice. At dinner, other people will be talking in Spanish, and she'll occasionally say, Bob, what they're talking about is... So I feel like the last few years like I'm a little child, right? And these people are the grown-ups around here. Also, let me just explain, I'm operating under constraints. Before my talk, this is not a joke, these two ladies approached me, and I could tell something was wrong, and they said, Bob Murphy, we have been watching your YouTubes. You talk too fast, right? And they said, not only do you talk too fast, you talk about fighting Krugman in the toilet, you talk about Aquaman, then you talk about the Federal Reserve. No. All right. I don't know what accent that was. It wasn't their accent, but that was something. Okay, so I just want to clarify, I'm not Aquaman. On Facebook, I'm Captain America. Right? Just make sure there's no miscommunication. And it's ironic. I mean, I obviously have to follow their instructions, right? If you think about it, it's funny, we as Austrian economists and libertarian political theorists were very aware of the concentrated power and how arbitrary power can, allow people to do whatever they want, and we're point that out to people. The two most powerful people at this conference, they're sitting right there. If they want to right now, they could just start saying how, and he is now, Paul Krugman is a very smart economist. How would I know? I wouldn't know, right? They could do what they want. You guys think I'm joking. Okay, you probably heard about how there was a water pipe break. Look at it, there's covered in water here. It's like a moat, and this is the medieval castle. This is bulletproof glass. Look at this. They're sitting here in a bunker instructing me on what to say. I'm the keynote speaker, and I have to follow their orders, and you guys just think this is all a big joke. All right. Probably I should start speaking about capital theory at some point. So let me also say I'm going to tell an anecdote, a story, and if you're an undergraduate student, you might not understand this, but don't worry, later in the talk, I'm going to say things that are much more accessible. This is the truth that at this conference, I have heard more references to the work of Eugen von Bombaverk than I've ever heard anywhere else. All right, and my PhD dissertation was on the work of Bombaverk. So, of like the 10 people on planet Earth who are going to understand this next story, 8 of them are in this room right now. So, just again, also there's going to be an additional benefit that for those of you who are younger, it's good if in the beginning I say some things and you have no idea what I'm talking about, right? Because then you're going to say, this guy must be really smart because I don't know what he's talking about, and then maybe you'll pay more attention later in the talk. Okay, so the story is, and it unifies some earlier things people were talking about mathematical economics and how the promise, the alleged benefit of translating economics into mathematics is the precision, and we'll guard ourselves against falling into fallacy, right? That it'll be internally consistent. We won't contradict ourselves. We won't argue in a big circle the way we might do if we just relied on verbal exposition, right? So that's what the theory is, and that's what a mainstream economist would say as to why do we use mathematical models, and they would criticize Austrians for being stuck in the past. And then also, I'm going to, again, my story involves the work of Bombaverk. And so what happened was at NYU, I was studying, and Bombaverk had a critique of what's called the naive productivity theory of interest. And specifically, Bombaverk showed, this was back in the 1800s, he showed that to say the interest rate is, or the existence of a positive interest rate is due to the productivity of capital Bombaverick showed that that's a conceptual mistake, right? That it's like getting the dimensions wrong, if you will. But at the same time, what I was learning, getting my PhD in economics from New York University with these mathematical neoclassical models, we were finding that in equilibrium, the real wage rate was equal to, in words, you would say the productivity of labor. Right? So you'd have a production function that had labor as an argument. You would take the first derivative of the production function with respect to L. Right? So put epsilon more labor in. How much does output go up? And then that's what workers get paid if there's competitive labor markets. Right? And so Austrians are okay with, they don't like the math part per se, but the theory's fine. But then in the same mainstream model, it would say in equilibrium, the real interest rate is equal to the marginal product of capital. And it would be very analogous. They would have a production function that would have capital K as an argument. They would take the first derivative with respect to K. So put an epsilon more capital into the production function. Output goes up a little bit more. And that difference, that increment, is how much the capitalists must be able to charge if there's competitive markets, in capital. And so mainstream economists getting PhDs at good universities were learning that interest is due to the productivity of capital. So you see the problem that, wait a minute, we're learning what Bombaverick showed in the 1800s is a fallacy. So how can this be? And it took me a while to figure out what was going on, because the math was correct, right? And so that was true, that somebody who thought the reason we're going to write our description of the economy down using math is it protects us from making a careless mistake. We know our system is internally consistent. So that was right. The math was correct. But yet, how could those two things both be true? And I reviewed Bombaverick's verbal argument, and that also seemed true. So what was the solution? And I realized what it was, that the mainstream models only had one good. Right? So there was a capital K of capital stock, and then you could either, the representative agent, right, there's only one person in this economy who lives forever. It's a little bit unrealistic, but can either consume to get utility or put it in the production function, and then it generates, a bigger pile of K next period. Okay, but the crucial point was, in the world of this model that was the standard model we used, the capital good was literally the same physical thing as the consumption good. And so you could picture it as like a crop that would physically, or sheep. That was an example they might use from Irving Fisher. Like if you have 100 sheep, you can kill some and use them, for consumption, or you can refrain, and then natural processes, the 100 sheep physically turn into 110 sheep next year. So then the real rate of interest would have to be 10%. Okay, so what I realized is, if you're thinking of the world in terms of a model where there's only one good, that is both consumption and the capital good, then Bombaverick's critique doesn't work. Like, it doesn't matter. That's the one special case. So I thought, okay, I'm going to do what the mainstream economists say. I'm going to write these verbal insights from the Austrians down in a mathematical model to show the mainstream economists, look at the mistake you've been making, or look at the danger, to make sure they realize that you shouldn't say interest equals the marginal product of capital. So I did that in my dissertation. It's in the appendix. I took, a Bombaverick approach and made so I made a model that had two goods. That was the only change I needed to make. And then I came up with the equation, what's the interest rate in equilibrium? And it was not equal to the marginal product of capital, but I showed if you made it one good, like the equations that were more complicated, simplified down to say R equals the marginal product of capital. So it was sort of like, I'm not saying it was as good as Einstein, but it was the same way that, Einstein's equations that are true in general, if the object's going very slow and there's not a lot of gravity, reduced to Newtonian mechanics, right? So it was like that. I was really excited. I showed my grandmother. She didn't know what I was doing, but okay. So, because I live with my grandma when I was in grad school. Okay, so I was really excited and thought, aha, I'm going to go show these mainstream economists. And the people I showed, these were very intelligent, open-minded people. So I'm not making fun of them, but I just want to show you to not be naive when they defend the mathematical approach, because I went into this guy's office and I showed him the equations to say, look at, you see how if there's two goods or more, then interest does not equal the marginal product of capital. So you should stop teaching that, because it's only true in a world where there's one good. And he looks at the equations, and we were talking about a specific story where you use tractors to harvest bananas. That's kind of silly, but that's the story we were using. So I was showing him, he had thought, well, if 100 bananas physically turn into 110 bananas, and I was showing him, but what if you're actually using a tractor? The tractor price quoted in bananas. So I'm going through all this stuff to show him, Bombavric's point holds there, that you don't know what the real interest rate is because of these physical facts. You have to know things about subjective value. And his response to me, he stared at the equation and he said, assume that you can turn tractors into bananas 1-to-1. And that was his solution, okay? So, again, just in case the translation was difficult, his solution to that was to say, okay, yes, in your model you're right, but we can make the harmless assumption that you can physically turn tractors into bananas at a specific rate of 1-to-1, right? And then that will solve all the problems. So, and I couldn't prove he was wrong, right? If you assume that, then the problem goes away. But you see my point. I hope that they were so locked into thinking like that even when I did translate the Austrian insight from capital theory into a mathematical model that was what they were using, but it was just a little bit more realistic, they weren't going to abandon the way they had been teaching it, and they just made a crazy assumption to fix it. Okay, so here's the outline of what I want to talk to you guys tonight about. I'm going to motivate why the Austrian approach to capital is still relevant, besides my graduate school story, focus on the Keynesian and the market monetarist approaches, because they do not have a rich capital theory. Then it's going to be review probably for most of you, but just show you what the Hayekian triangle is. Then I'm going to show Rothbard's version of a circular flow diagram to show you why you can see things with his version that you can't get in a mainstream version. Very briefly, Austrian business cycle theory, and then the analogy Ludwig von Mises uses. And then I hope we have a little bit of time at the end. I may have to skip some of these, but I want to just show you this isn't just verbal philosophy and just doing things from the armchair. We can, in terms of empirical arguments with mainstream economists, show the strength of the Austrian approach. And so I'm going to use some specific examples of when Paul Krugman, for example, was saying that the recession is all about aggregate demand. This sectoral readjustment or rebalancing story is wrong. That's what Paul Krugman said. And then I went and got data to show actually the data is consistent with the Austrian story, whereas it's not consistent with a story about, demand just collapsed for some reason in 2008. Okay, it's not important that you read this. Let me just tell you the highlights. So this is a screen capture I did from Paul Krugman, his blog post from October 9th, 2011. He called it IS Elementary, so that it was kind of like a pun, like to say it's elementary, ISLM. So what he was showing here is that, hey, look at how easy, just using the ISLM diagram from Hicks, that's very old, and a lot of economists think, that's quaint and we're much more sophisticated now. Krugman was saying, look, at using this simple model, I derive predictions about interest rates and price inflation, and my predictions were right, and the people who were worried about quantitative easing and trillion-dollar U.S. budget deficits, they were wrong. And so he was trying to praise the power of this model. So it's not important for our purposes right now to parse the particulars of the argument, but I just want to make sure you realize I'm not setting up a straw man, that when Paul Krugman was saying this is the tool I was using to give policy recommendations and to diagnose what was wrong with the world economy, he was just drawing literally two curves on a piece of paper. Now, also, again, it's not important that you read this, but this is a screenshot from Scott Sumner, who's one of the leading, at least in terms of online presence, what's called market monetarists. So they're, from the Chicago school approach. That's where they get the monetarism. But they think central bank policy should be tied to the market's expectations of nominal GDP growth. So Sumner also has been very critical of people who have said that central banks have been too loose with their monetary policy. So here, Sumner, again, this is a screenshot of his blog post. Here, Sumner was quoting, I don't even know how to pronounce this guy, Lichtenschlager, who was criticizing a certain central bank stance, saying ever looser monetary policy had its limits and that money printing had yet to stabilize sinking price inflation, its formal goal. All right, so Sumner was quoting an analyst who was criticizing central banks in 2000, so this was from 2015, and so this analyst was saying, they've been trying quantitative easing for years now, it's not working, maybe we should try something else. And Sumner's response to that was to say, suppose you tried to illustrate Lichtenschlager's concerns using an aggregate supply, aggregate demand model. The most straightforward approach would be to shift the AS curve to the left. But this would cause higher inflation, whereas the Eurozone is facing excessively low inflation. All right, so again, he was doing the same rhetorical approach as Krugman. He was saying, just draw two curves and move one, and then whatever would happen in that simplistic model with two curves, if that's not what's going on, then we know the problem can't be that money is too loose, because otherwise consumer prices would be doing such and such. So I'm not going to tackle these two things right now, but I just want to make an analogy. We're so used to thinking like this as economists, I think sometimes we forget how crazy that would be in a different realm. So imagine if you were having stomach pains and you went to see your doctor and he pulled out a diagram, he said, and it showed an outline of the human body, and then he just drew two lines that intersected and just said, well, clearly we're not giving you enough medication, because if we were, you would see your temperature would be 110 and it's not, so why don't we give you more pills, right? And if they just had two lines moving around, I think you would go to a different doctor, right? It doesn't mean that the first guy was wrong. It just means you're going to diagnose something as complex as the human body with two curves on a white piece of paper, and that's the extent of of the variables you can handle is two curves moving around, and the curves aren't even calibrated to anything. They're just straight lines that you draw off the top of your head, right? Because that's what economists typically do in these things. It's not even like they go and measure what does the curve look like, right? So it's extraordinary. Again, because most of you have studied economics, I don't think it's fully hitting you how crazy that is. But so what's good is the Austrian approach, it might be wrong, but at least it has a chance of capturing the complexity of what's going on in the world economy. So to summarize some of this, I'm going to move quickly through this. This is the Hayekian triangle. I grabbed this slide from Roger Garrison's PowerPoints. So if you've never gone through them, I highly recommend you Googling Roger Garrison PowerPoint presentations, and he has them all at his website. And so it's fascinating, and it just shows you like Hayek versus Keynes in terms of the representation, and he does it using standard mainstream techniques like a production possibilities frontier, loanable funds diagram, and so on. So Garrison translates the Hayekian story into mainstream diagrams to make it more accessible or communicable to outside readers. But just to make sure you understand what the triangle is, so I'll read this. These are Garrison's words. So at a given point in time, an ongoing production process is characterized by activities in all the separate stages. So these are the stages. Dividing the economy's production process into 5 stages is a matter of pedagogical convenience. So what Garrison is saying is he picked 5 stages, but obviously that's just for simplicity to make the point. Because if you only did 3, that wouldn't be enough to tell the story. But if you did 6 or 7, that doesn't give you anything additional in terms of explanatory power. Okay, so again, just to be simplistic, we can call it mining, refining, manufacturing, distributing, and retailing. So the way to read this chart is time goes left to right, and then the height of this is the market value of the goods in process. So the idea is that in an economy, and this goes back to Menger and the way he organized the structure, the production structure, that retailing, this is like the consumption. This is where the consumers get access to the goods, and then it goes back in time. So this is the most remote from consumption. So here's where they extract raw materials from the ground, and then they pass it on to the next stage. Here's where they're refined, then they're given to the manufacturer, then the distributor, and finally the retail outlets. Okay, so the market value of these goods in process increases over time. And so this is the basic diagram. I think actually an easier way that I prefer to teach it is using Rothbard's approach. So he has, this is coming from Murray Rothbard's Man, Economy, and State. Let me see how much time I got here. Okay, I got time. Let me spend just a few minutes explaining this diagram, because once you see it, you'll get a sense of the richness of Austrian capital theory. So one thing is, we rotated it. This is how Hayek originally did it. So Garrison's was like going this way. We rotated it back this way. So time goes down this way. So up here, so these are the 6 stages, and consumption's down here. So as we go higher, we're getting further away from consumption. And so what this overall depicts is an economy that's in a long-run stationary equilibrium, but let me show you all the components. So up here at the highest stage, this is where raw labor interacts with nature, right? So land and labor factors, a capitalist up here spends 19 ounces of gold, and it goes to land and labor factors, right? So the arrows are showing which way expenditures are flowing. So this could be something like just someone with his bare hands planting seeds and getting wheat, for example. All right, so we're not using any capital here. And so the 19 ounces, then the next period gets sold for 20 ounces of gold. All right, because these things mature, so like they plant the seeds, and then next period it turns into wheat, and then they sell the wheat for 20 ounces. So this 1 right here, that's the difference. It's 20 minus 19 is 1. And you'll see this is interest income. So all these are earnings of interest to the capitalists. Because at each stage, and this is part of what the benefit of a diagram like this is, at each stage, a capitalist has advanced money to the factors of production and then has to wait and then sells the finished product to the next stage for more money. So that gap is the interest earned. All right, so the next stage, so this capitalist gave 20 for the capital good, spent an additional 8 on more land and labor factors. So that's why that 8 goes up there like that. So that means this capitalist at this stage spent a total of 28 ounces of gold, waited 1 period, and sold the ripened product for 30. So 30 minus 28 is 2. So this capitalist earned 2. Right, so that's how it works all the way down to here. The second last stage, this is like the retail stage. So at this level, the entrepreneur right here gives 80 for the goods in process. So if we're talking about bread, at this point, you know, it's already the bread is in loaf form and it's been put in a bag and so on, and maybe the trucks are just bringing it to the grocery store. And then this 15 is more land and labor factors, like maybe hiring workers to be the retail clerk, you know, to sell the bread and take the money and so on. Okay, so at this stage, the person puts in 80 to buy the product from the previous stage and spends an additional 15 on more land and labor for a total expenditure of 95. And then the consumers, this is 100 ounces of consumer, in this last stage, all the bread is finally bought for 100 gold ounces by the consumers collectively. So this capitalist advanced 95 the period before, earns 100, and so that's why there's a 5 right there, right? Because they spent 90, they advanced 95, waited a period, and then got 100 from the consumers, and so that's why they earned 5. Okay, so you've seen how it works through time, but now, if this is long-run equilibrium, every period, this process starts anew, that they give 19 ounces to land and labor to start planting wheat. And every period, the goods in process change hands and the money flows, so that if this keeps happening time and time again, you can step back and look at the pattern that this capitalist earned 1 every period, this one's 2, 2, 3, so that's a total of 17 ounces. Here, the land and labor factors, like so the landlord, you know, the people who own the farmland and the workers, they earn 19. Here they earn 8, 13, 12, 16, 15. If you add all that up, it adds up to 83. So it's 83 plus 17 is 100. So this is like the circular, this does all the work that the mainstream circular flow diagram does, where you can see how workers and landowners and capitalists derive their income in different components of the economy, but then it's all consistent, that this 17 plus 83, that's their net income each period, and that's exactly how much is spent on consumption. So what's interesting about something like this is you can start telling stories about what happens if there's more saving and what happens to interest rates, and that's the sort of thing that Hayek would use it for. But even at this simple stage where we just have long-run equilibrium, we can already show one of the deficiencies in the mainstream approach, which does not have a very rich capital structure. Because if we depicted this economy and asked a mainstream economist, what's the GDP in this world? They would say, oh, it's 100 gold ounces worth of bread or whatever the goods are, right? But GDP here every year, every period is 100 ounces of gold in nominal terms. And then if you said, okay, what are the factors, the components of GDP in this economy? 100% would be consumption, right? That's the way mainstream economists would compute it. They would say 100% of this economy relies on consumption, 0% is on investment spending, because you might be puzzled. You say, wait a minute, but look at all this investment spending here. Like this capitalist advances 20 plus 8. This one advances 43. This one advances 57, 70. You can see how at each stage there's actually a lot of investment. And if at any point if any of these capitalists just stopped doing that, the whole structure would collapse. So like if this capitalist right here for some reason decided, instead of only consuming 2, which is his net income, he could spend 43 ounces of gold, or sorry, 45, right, because he's selling all this next period for 45. When he got those 45 ounces of gold, he could go buy just bread with it and eat it. There's nothing forcing him to reinvest it, right? But this whole structure only keeps going if every period most of the capitalists reinvest most of their revenue into buying the capital, you know, the goods in process, and then adding more value to them and then selling them to the next stage. And so you see that quite clearly here, where if somebody said 100% of this economy is due to consumers spending money on bread, you would see that that would only tell a very small part of the story. So don't misunderstand. Mainstream economists don't think that bread just comes out of the sky, except the professor at NYU who said tractors turn into bananas, right? So they understand that conceptually, and they'll say, oh, well, we don't want to do double counting. All right, so there's a rationale for why in an economy like this they would just say it's 100 ounces, because it would be misleading to say every period the economy produces 80 units of bread that's almost ready and then 100 units of fully ready bread. They'd be worried that that would be overstating production. But my point is, in an economy like this, people would say, oh, 100% of GDP is due to consumption. If consumers get worried about the future and they start saving too much, the whole economy is going to collapse. Right? I think you've probably heard in the United States, it's like 70% of GDP is consumption analyzed this way, and that's how they talk. They say that it's really important to maintain consumer spending because it underlies the economy. But again, that's misleading. It's really, you can see, it's mostly what we call gross investment. Okay, so this is just an example of how using a standard Austrian diagram, this is from Man, Economy, and State, just showing you how important it is to have a rich conception. And obviously, even this diagram is very simplistic, but it's a lot more sophisticated than two curves intersecting, is my point. And you can start seeing, so when you start worrying about the business cycle or the possible bad consequences of having negative interest rates for 3 years or whatever, if you have a structure like this, you can see how imbalances might develop here and take years to fully manifest themselves. Whereas if you just have two curves and the central bank tries quantitative easing and consumer prices don't shoot up, a lot of mainstream economists are going, oh, I guess there wasn't a problem, let's try it again. Or let's do double QE. Whereas here, you could see there could be problems that would start festering. It might take years to work their way through the pipeline. Okay, so let me very quickly review what Austrian business cycle theory is, and then I'm going to show you Mises' analogy. Okay, right, okay, so I'll speed up here. So the basic Austrian story, I'm assuming most of you are familiar with it, is that what helps coordinate that process to make sure that all those components of that diagram I showed you are synchronized is interest rates. So they are prices, and their particular function is to coordinate household saving and entrepreneurs' investment projects. And so in this paradigm, easy money, meaning monetary policy that's too loose, too aggressive, most economists would say, oh, the possible danger is that it leads to, they would say, inflation. They mean rising consumer prices. And that's one possible danger, but that's not the standard Austrian critique. They're saying that it leads to artificially low interest rates and then causes malinvestments. Okay, so if you agree that interest rates are a price that serve a function, if they're the wrong price, that's not helping anything. That's distorting the capital sector. Right? And so what happens is the capital structure becomes unsustainable, and that makes a recession inevitable. So when you understand the Austrian story, you'll see that a recession is not because of this inexplicable collapse in demand. And then, oh, so to fix it, all we need to do is to boost demand, and then we'll have everything back to normal. In the Austrian story, there was a period of malinvestments. So the capital structure was physically unsustainable. Like that diagram, that how that all interlocked very nicely in a long-run equilibrium, it's distorted. So you can't have 100 gold ounces worth of bread shooting out of the pipeline if 5 years earlier people didn't plant the right amount, right? Or if halfway through, if some entrepreneur decided to spend all his money on consumption and didn't reinvest, now there's this gap in the pipeline that's coming down, and there's nothing you can physically do about it. It's not just a matter of getting people to spend more at the grocery store. So let me quickly tell you that the best way of showing this, I think, is Ludwig von Mises' master builder analogy, to try to illustrate the difference between saying the Austrian theory is one of overinvestment versus malinvestment. So Mises said, imagine there's a builder who has a blueprint, and he assumes he has a certain number of bricks to use. But in reality, physically, he actually has fewer bricks than he believes. And so as he's building the house, at what point would he want to learn about that discrepancy? And the point is, as soon as possible. If he's building a house that relies on blueprints that assume he has 10,000 bricks, but really he only has 8,000, the sooner he learns that error, the better. Because if he keeps building the house, his options keep shrinking. And so Mises said, the central bank, when there starts to be like a problem in the economy and they keep lowering interest rates and keep pumping in more money, he said that's like trying to keep the entrepreneurs from realizing how few resources they really have. That's like to keep the illusion going. And so something simple like building a house, we could see why that would be a mistake. You wouldn't want the illusion to keep going. You'd want them to know. And so we can extend this analogy. I think it's very useful, and just think more about what would happen in reality. What if the builder really did learn that the bricks were, he only had 2,000 fewer bricks than he thought? He would take out the bullhorn and say, stop. Everyone stop working. And everybody would stop. And then he would have to revise the blueprints in light of the fact that he had 2,000 fewer bricks than he believed. So that's sort of analogous to a recession where the economy is moving along and then a lot of things stop or slow way down, and there's a lot of idle resources while the economy rethinks the plan. So of course it's a metaphor. There's no one person in charge of the economy, but in the Austrian view, if the economy is on an unsustainable path, a crisis period where a lot of entrepreneurs realize they made a mistake is good. You want them to do that. You want them to, if workers shouldn't be going to a factory, they need to stop doing that. Okay, let me, and so I have a gazebo here. Imagine someone comes up to this work site where the builder realized there was an error and then sees workers who stopped working, and some politician says, well, this is wasteful. I see lumber, I see bricks, I see skilled carpenters. Go build a gazebo and put my name on it, right? And it would be a make-work, shovel-ready project. And then for the next generation, that gazebo would be there as a testament to the wise politician who used those idle resources because the silly builder was just dumb and wasn't using them for some reason. And you can see that would make it worse. If already the house was not in a sustainable trajectory and the builder needed to really economize on those resources now to say, how do I fix this bad situation? And then someone built a gazebo with some of the limited resources, that would be worse. So by the same token, if there's a bad recession because of earlier monetary stimulus, and then the government runs big deficits to build bridges and roads and stadiums and things that aren't really that necessary just to put people to work, that's the worst time to do that, when the economy is already reeling from previous malinvestments. Okay, let me, I'm running low on time here. Let me just show you two things that I'll end with, and then I'll turn to your guys' questions in terms of empirical support for this sort of verbal theory I've given you. So Krugman, one of the things he said, and if you want afterwards I can email you and show you the specific articles, but in the wake of the 2008 crisis, Krugman was tackling the objection that it was a sectoral imbalance and that, there was too much in housing and now the economy needed to reshuffle the resources. Krugman didn't think that was right. He thought the real problem in 2009, 2010, the reason unemployment was so high was just a lack of aggregate demand. So he acknowledged the housing bubble and collapse may have scared people psychologically and made them not spend, but he was saying the real problem with the economy was a lack of spending, and he was pointing to some statistics to try to show that it's a general downturn in the economy. So one of the things I did to show that no, it's the Austrian story makes a lot more sense is I looked at decomposed employment in terms of construction. So that is that's the blue line, durable goods, which is the red line, and then non-durable goods, which is the green line. And I made it an index. So I related each one to their value from 2007 to 2012 would be 100, And then you could see how it played out over the course of that period. Or sorry, this is December 2007 was 100, and then so I'm just going to make 2 more points. And so you can see this is like a percentage change. So you can see how over time the drop in non-durable goods was only a little bit more than 10%. The drop in durable goods was more pronounced, and then the drop in construction was about 25%. So if this were just a general reduction in aggregate demand, it's not obvious why you would see the things play out like this. You actually might expect the non-durable goods to drop more if the consumers froze up spending, and then over time it percolated into other industries. But this story makes perfect sense if you have the basic Austrian theory of the business cycle in mind. This fits perfectly. So let me show you one last example of what I've been working on, and just to try to show how the Austrian story, I think, gives relevance. And you don't need to publish papers calling it Austrian economics, but I think there's lots of things Austrians can contribute to financial economics. So this is just one example. You may be familiar with this empirical pattern that says an inverted yield curve predicts a recession. And so certainly with U.S. data, this is valid going back decades, where if you define it appropriately, so the yield curve is the maturities of interest rates. So short-term bonds usually have a lower yield than longer-term ones. So if you're going to lend money to the U.S. government for 6 months, you're going to typically get a lower interest rate than if you lend it for 10 years. But sometimes that inverts, and the yield on shorter-term bonds is higher than longer-term. And so when that happens in the last several decades, if it does happen, there's always a recession very soon after. And if there is a recession, there has always been a recent prior period of an inverted yield curve. So it's very tightly associated with just some minor, borderline cases. And so what I'm going to close with here, just to show you, is if you had the Austrian business cycle theory and you believe that independently, and then just asked yourself, what would the data look like if that were true? I'm saying notice that it would have an inverted yield curve. So here I decomposed it to show the 3-month T-bill and the 10-year Treasury. And so the 10-year is the red and the blue is the T-bill. So you can see typically the blue is below the red, right? So normally the interest rate on 3-month U.S. Treasuries is lower than the interest rate on 10-year Treasuries. But you can see occasionally, see how the blue line goes up above it? And the same thing here, and the same thing here, and the same thing. So these rare occasions when the blue line shoots above the red line, and then there's always a gray line right after. The gray lines mean recessions. So here I'm just illustrating to you the standard pattern of an inverted yield curve for some reason predicts a recession that's ensuing, but I'm pointing out to you now that this is basic Austrian theory. That's not surprising, because what happens during an expansionary phase, a boom, they're pumping in money that would raise long-term price expectations and push down short-term interest rates. So you would expect the blue line to be below the red line, or here, see? But then when the central bank tightens and stops pumping in money, that's going to raise interest rates, but it's not going to raise 3-month and 10-year rates the same. It's primarily going to raise short-term rates, because central banks have much more influence over short-term rates. So if the central bank all of a sudden slams on the brakes, you would expect short rates to shoot up, and long rates might even go down because of lower expectations of price inflation. If now that they know there's not as much money being created, 10-year yields might actually drop slightly. So my point is, this is exactly what you would expect to see, this pattern, if you believed in standard Austrian business cycle theory. If you thought these gray lines were the result of a prior period of monetary expansion that then came to an abrupt halt and led to a recession, this is what you'd expect to see. So I think it just shows, and the mainstream theories to explain this, I think, are pretty unconvincing. They try to explain it with rational expectations and things like that I don't think fit the data very well. So I'm just pointing out that the Austrian theory of the business cycle explains this, but you need capital theory for this to make sense. That's why there would be a prolonged recession, and they couldn't just forever keep the blue line below the red line, right? Because there's a physical thing going on. If it were just a matter of two curves in spending, there's no reason the boom couldn't continue. It's only when you have an idea of a structure of production that you see how the boom could exist for a while, but not forever. And that needing that long-term capital structure is the only way to get that outcome. Okay, I will stop there. Thanks for your attention.